Hello, savvy investors, it's your friend, your name, here to talk about something that can make a huge difference to your bottom line, minimizing taxes. Look, we all work hard for our money, and the last thing we want is to see a big chunk of it disappear come tax season, right? That's why today we're diving deep into the world of tax-advantaged investing. We'll be exploring proven strategies that can help you keep more of what you earn. Get ready to take notes because we're about to unlock a world of tax-saving opportunities that can supercharge your journey to financial freedom. All right, let's kick things off with one of the most popular retirement savings plans out there, the 401k. Now, you've probably heard of this one, maybe even from your employer, but here's the deal. A 401k lets you contribute pre-tax dollars, meaning you're reducing your taxable income right off the bat. Think about it. The less money Uncle Sam sees, the less you pay in taxes. Plus, your money grows tax deferred, which means you won't owe a dime in taxes until you withdraw the funds in retirement. It's like a double whammy of tax savings. And here's the kicker. Many employers offer something called an employer match with their 401k plans. This means that for every dollar you contribute, your employer will match it up to a certain percentage. It's basically free money, people. Now, let me be clear, I'm not a financial advisor, so this isn't financial advice, but seriously, if your employer offers a 401k match, you need to be taking full advantage of it. It's one of the easiest and most effective ways to start building your nest egg while keeping more money in your pocket. Next up, we're diving into the wonderful world of IRAs, or individual retirement accounts. Now, there are two main types of IRAs, traditional and Roth. Both are awesome for building a secure retirement, but they have different tax advantages. With a traditional IRA, you get to enjoy those sweet tax deductions up front. Similar to a 401k, your contributions are often tax deductible, which means you can lower your taxable income right now. Plus, your money grows tax deferred until retirement. On the other hand, a Roth IRA offers something even more powerful, tax-free withdrawals in retirement. While you don't get the upfront tax deduction with a Roth IRA, all the money you contribute grows tax-free, and you won't owe a single penny in taxes when you withdraw it in retirement. So, which one is right for you? Well, it depends on your individual financial situation and whether you think your tax bracket will be higher now or in retirement. Let's talk about HSAs, or health savings accounts. Now, this one is a triple threat when it comes to tax savings. I'm talking about tax deductions, tax-deferred growth, and tax-free withdrawals for qualified medical expenses. If you're enrolled in a high-deductible health plan, you can contribute pre-tax dollars to an HSA. This means you're reducing your taxable income right from the start. And just like with 401ks and IRAs, your money grows tax-deferred, sheltering it from taxes while it's growing. When you use the money in your HSA for qualified medical expenses, like doctor's visits, prescriptions, or even dental care, those withdrawals are completely tax-free. Now let's shift gears and talk about a tax-efficient investment that can generate some steady income for you, municipal bonds. These bonds are issued by state and local governments to fund public projects like schools, roads and bridges. But here's the kicker. The interest you earn on most municipal bonds is completely tax-free at the federal level. And if you live in the state where the bond was issued, you might even get a state and local tax break as well. Municipal bonds might not offer the highest returns compared to some other investments, but their tax advantages can make them a valuable addition to a well-diversified portfolio. As always, do your due diligence before investing in any bond, including municipal bonds. Let's talk about one of my all-time favorite investment vehicles, index funds. These bad boys are like the superheroes of the investing world, offering broad market exposure, low fees, and yes, you guessed it, tax efficiency. Index funds are designed to track a specific market index, like the S&P 500 or the Dow Jones Industrial Average. Because index funds have a buy and hold strategy, they tend to have lower turnover rates compared to actively managed funds. This means they generate fewer taxable events like capital gains distributions, When a fund manager buys and sells stocks within a fund, it can trigger capital gains or losses. Index funds, with their lower turnover rates, can help you minimize those pesky capital gains distributions, keeping more money in your pocket. Next up, let's talk about real estate investment trusts, or REITs for short. Now, I'm a big fan of real estate, but I know it's not for everyone. That's where REITs come in. They allow you to invest in a diversified portfolio of income-producing real estate properties without the headaches of being a landlord. We're talking about things like apartment buildings, shopping malls, office spaces, and even cell towers. And here's the tax perk. REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. While those dividends are generally taxed at your ordinary income tax rate, REITs can offer some depreciation deductions which can help offset some of your tax liability. For all you parents and grandparents out there, listen up. If you're looking to save for a child's education, 529 college savings plans are your new best friend. These plans offer fantastic tax advantages that can help you supercharge your education savings. You contribute to a 529 plan, and the money grows tax deferred, just like with a retirement account. When you withdraw the money for qualified education expenses like tuition fees, books, and even room and board, those withdrawals are completely tax-free at the federal level. Some states even offer state income tax deductions or credits for contributions to their 529 plans. So, you're essentially getting a double tax benefit. Let's talk about life insurance. I know it's not the most exciting topic, but it's crucial to have adequate coverage to protect your loved ones in case something happens to you. And guess what? Certain types of life insurance, like permanent life insurance, offer some pretty sweet tax advantages. Unlike term life insurance, which only provides coverage for a specific period, permanent life insurance, as the name suggests, provides lifelong coverage. It also includes a cash value component that grows tax-deferred over time. This means you won't owe taxes on the growth of your cash value until you withdraw it or surrender the policy. And if you need to access those funds during your lifetime, you can typically borrow against your cash value tax-free. Now let's talk about something close to my heart, giving back to causes you care about. And here's the great news. When you donate to qualified charitable organizations, you can often claim a tax deduction on your federal income taxes. This means you can reduce your taxable income and potentially lower your tax bill, all while supporting a worthy cause. To claim a charitable deduction, you'll need to itemize your deductions on your tax return. Keep in mind that there are limits on how much you can deduct based on your adjusted gross income and the type of charitable organization you're donating to. So consider incorporating charitable giving into your financial plan. Last but not least, let's talk about the power of long-term stock investing. You see, when you hold on to stocks for the long haul, meaning more than a year, you unlock the magic of long-term capital gains tax rates. These rates are generally lower than your ordinary income tax rates, which can result in significant tax savings over time. For example, let's say you're in the 22% tax bracket. If you sell stocks that you've held for less than a year, you'll pay that 22% rate on your profits. But if you hold on to those stocks for longer than a year, your capital gains tax rate could drop to 15% or even 0%, depending on your income level. There you have it, folks. We've covered a lot of ground today, from tax-advantaged retirement accounts like 401(k)s and IRAs to the power of index funds, REITs, and long-term stock investing. It's always a good idea to consult with a qualified financial advisor who can help you create a personalized investment plan that aligns with your financial goals and risk tolerance. Maximize your earnings and minimize your taxes. See you in the next video.